guys, and welcome back to Sloth Finance. My name is Zach, and today we are going to be looking at the overall market, where crypto is headed, and how I just took profits on a trade resulting in a 30% profit. After looking at TradingView, I will show you a couple of clips of expert traders and general news so everyone can get a feeling of the sentiment surrounding the market. If you like today's content, hit the sub button and leave a comment below. Without further ado, let's look at Ethereum on the 4-hour time frame with Binance as the data source. Since ETH broke this trend line right here, it has been on an absolute tear this year. And hopefully everyone was able to take advantage of it. If not, hopefully this video can help you so next time you'll be able to benefit from it. I bought 1.45 Ethereum around the beginning of the year and just sold to make around a 30% profit. So I bought it around $1,300, somewhere around there, once it broke out, and I sold around the $1,700 mark. So a lot of you are probably saying, whoa, wait, hold on a second, why did I sell? Because Bitcoin and crypto is just exploding, and the Moon Boys are saying that it's going to 1 million. What is going on? In my opinion, this is a bear market rally to trap liquidity and to demoralize the retail trader that just bought in. Because once you start hearing all the influencers and the media outlets saying positive news, like right now, like where we are, that's when the retail investor will buy in and they will get burned time and time again. I personally think we're going to hit this trend line and bounce down to around the $1,300 level, possibly lower. It is important to talk about not only the technicals, but the environment as well. The banking and traditional finance system is failing, and previous data has shown that Bitcoin is correlated to the S&P. Could the collapse of SVB and Signature Bank be the event that disconnects crypto from the confines of traditional finance? Maybe, but I think this pump is more fear-based regarding the banks than confident in Bitcoin. And that is why the money will eventually leave Bitcoin and previous lows will be revisited. That is one of the reasons why I'm keeping some cash on the side, so when we do revisit these lows, I can take advantage. I want to make clear that I do not have a crystal ball, and this is just my personal opinion. Next, I want to show a clip of Gareth Soloway and his prediction regarding Bitcoin and the rest of the year. Gareth is an expert trader with 10 plus years of experience and has an 80% success rate with multiple appearances on financial outlets. Let's hear what he has to say.
Yeah, so price target wise, I think ultimately I am on the downside here. I think as long as we are still up against this line, we have to respect it. So I'm looking for a pullback to the lower end of that channel, which is around the 20,000 level. Eventually, I think that actually breaks, and I do think we ultimately test over the next 2 to 3 months. We test that 15.7 level again. And again, hate to be bearish out there. I know so many people are bullish. I'm just not seeing the signals yet. For me to be bullish overall and think a low is in on crypto and this isn't a bear market rally, we would actually have to establish ourselves back above 30,000. And we're not that far now. So, I mean, it could be in the next few weeks that I change my tune. But again, it has to be 30,000 because that's your midpoint. All right. So if we look at psychological levels on the chart, remember that big move up in early 2021 and then the pullback, right? And the low of that pullback of that cycle was right at 30,000. And then we went up and we made a new high, and then we came back down. We consolidated here at 30,000 and finally broke lower. So to establish ourselves back above 30,000 psychologically would be huge for the Bitcoin market, and that would actually get me on the side of thinking, okay, maybe the lows are finally in. Until then, I've been through too many bear market rallies that fooled me, so I'm still on the bear market side until proven otherwise. So for me, it would have to be when we get above that 30,000. That's when I start to look to buy pullbacks. And just to mention this too is I've been long and short Bitcoin and cryptos overall probably about 5 or 6 times just in the last month because of this awesome volatility. But I'm talking more on the macro view, the bigger move. Then I start kind of hodling on pullbacks and buying the positions to hodl versus just looking to trade them on the long side, which is what I've been doing recently. So I think, again, the 12,000 level is still out there. I even think there's a chance of 9,000. I hope I'm wrong. But again, I do think that is a possibility still.
Now that you've heard what Gareth has said, let me know what you think in the comments below. Now, let's look at a couple articles on why I think it was a good idea to sell in this bear market rally and buy lower. The first article is by Cointelegraph, and it is more than 186 U.S. banks well positioned for collapse, SVB analysis reveals. Let's look at two articles regarding why I think it was a good idea to sell in this bear market rally and buy lower. The first article is by Cointelegraph. More than 186 U.S. banks well positioned for collapse, SVB analysis reveals. Rising interest rates, which brought down the U.S. banking system's asset market by $2 trillion, combined with a large share of uninsured deposits at some U.S. banks, threaten bank stability. Now, the perfect mix of losses, uninsured leverage, and extensive loan portfolio. SVB collapse came as a reminder of the fragility of their traditional financial market system. A recent analysis by economists showed that a large number of banks are at risk from uninsured deposit withdrawals. So how can a large number of banks be at risk from uninsured deposit withdrawals? This is because banks are only required to keep so much cash at hand, while taking the majority of the depositor's assets and investing it into different things. They do this by taking the depositor's money and putting it into bonds or other interest-generating assets. One of the main issues with this strategy is the assets the bank put their money in are locked into a specified time. So if a bank run occurs, the bank can't cover it, causing more panic. If anybody is familiar with the staking in crypto, it is very similar to that. If you stake an asset like, let's say, Atom, for example, it is usually locked for around like 2 weeks. And in that time, you can unstake it, but you will not have access to the asset until that 2-week period is up, and then you do. So if you needed that money right away, you wouldn't have access to it. And that could be a big problem. As the federal government steps in to protect the depositors of SVB and Signature Bank, President Joe Biden assured no impact on taxpaying citizens. He says people's deposits will be there when they need them, at no cost to the taxpayer. If you've been staying up with the news, you might have heard of Janet Yellen saying the same thing and proposing that this was not a bailout. She said this because taxpayers aren't involved. The government covered all depositors and was funded by the big banks who contribute to the FDIC insurance pool. From previous bailouts, we know that taxpayers really pay for the bailout, and supposedly it's different this time. However, when the insurance pool runs out or there are any other issues arise, won't the banks pass the bill to the depositors, which are the American public? I personally think there need to be serious punishments for the managers of this bank, as well as multiple sources have confirmed, saying that stock sell-offs months before the collapse have occurred. In my opinion, the government has to bail out the bank, as it will become a domino effect, as most banks are leveraged against each other. The banks know this and take more risk than necessary, which results in increased profit margins and larger earning calls. I think the system is just, something needs to change about it because it's not currently working. Let's look at our second article. SVB collapse was a Lehman Brothers moment for technology. SVB is a vital source of funding for tech startups. A lot of crypto companies had loans with these failed banks because other banks wouldn't consider them because of the high risk label that they received. Most crypto startups receive this from the traditional finance world. In terms of banking, the crypto industry has been set back a bit, and since tech usually does poorly in tough times, one can only speculate how low we go. And this is really, I think, being glossed over in the crypto market right now. Because if the funding for crypto, the VCs and the big money, if that support cripples, it doesn't matter for the traditional investor how much they have invested, because for crypto to really blossom and become the movement that we think it will, it really needs support of the big players like Goldman Sachs and VCs and the banking industry. I personally think that this will pass, and in a year, crypto will be looking good from a fundamental standpoint, even if Bitcoin is back at the 20,000 level. Now, with all this information, it is important to come to your own conclusion and do your own research. And for even more information, I would recommend watching Jon Stewart's latest talk with former Treasury Secretary about inflation and how the Fed manages it with outdated tactics, such as unemployment rates and interest rates, while ignoring rising executive salaries and earning reports. Inflation hurts the lower and middle class individual a lot more than it does people who make more money. I think that's just common sense. However, the Fed's tactics to raise the unemployment rate usually affect lower to middle income. So in tough times, when things cost more, they're cutting the people they're trying to help jobs. And then on top of that, they're raising the interest rates to make it harder for those people to finance a car or a home or something of that sort. So these tactics, in my opinion, are just outdated. And I think a more effective approach is to go after the corporations in some way. And because the data has shown in the last year that the earnings calls are just going up, and these companies are making more and more. These companies are taking advantage of the wave that came with COVID. During COVID, there were supply chain issues. And unfortunately, that issue really struck with the normal American because the cost of goods went up. And now that the supply chain crisis is primarily over, prices have not dropped because the corporations have realized, well, people are okay with paying these higher rates and they haven't lowered. So I think this point just exacerbates the divide between the normal Americans and the 1%. That is it for today's video. Let me know what you think in the comments below. And if you like today's comment, sub and hit that like button. An additional point, I'm not a financial advisor. This is just for entertainment purposes.